Sajid Chinoy, India economist at JP Morgan, is joining us. Sajid, good morning. It's always a pleasure to have you here. I want to start with, I think, what is on everybody's mind, which is when will the RBI cut rates? And if you look at the 10-year bond yields, yields have come down some 30 basis points in the last 1 month. Has suddenly expectations of a rate cut been brought forward, Sajid?
Yes, from a market's perspective, I think markets now believe that the very sharp reduction in crude prices, the fact that growth is still weak and therefore core inflation is weak, the fact that the monsoon picked up sharply in September and the government has undertaken some tactical actions to keep food prices in check. The combination of all these factors in the eyes of the market now, I think, make markets believe that a rate cut is coming relatively soon. If you look at the rates markets, people have begun to price in at least one rate cut, inching up towards a second rate cut in the next 6 to 12 months. I'm far more cautious. I think there's no doubt inflation risks have abated in the last 6 weeks or 8 weeks. But remember, we're now in a new regime, and the regime is trying to bring inflation down to 6% and keep it there for the foreseeable future. So when you're in this new regime, you don't react to any 1 month's inflation necessarily. You take a medium-term view on things. And I think over the next 12 or 13 months, there are enough risks on inflation that I think will worry the central bank, that they will not act in haste. I think only when the RBI is convinced that inflation is going to come down to 6% and stay there, even if some other risks materialize, will they be inclined to cut rates. So I think markets are, on the rate cut front at least, getting a little ahead of themselves.
And you think, the fall in bond yields, etc., is being driven by those hopes, which you are saying are misplaced. Those hopes are misplaced.
Well, bond yields are funny things, right? Because they, in a way, they encompass, they reflect various dynamics. Clearly, on the one hand, it is that rate cuts could come down. On the other hand, with oil prices coming down by $30 a barrel, that significantly increases the visibility on the fiscal deficit, and any thought that markets may have had that the 4.1 number will not be met is now being replaced by the fact that many people now believe it will be a number below 4.1. Diesel prices have been deregulated. We're hearing from the Prime Minister's office that the LPG cylinder subsidy may be fixed. So a lot of good things are happening on the fiscal front. Clearly, from a relative perspective, India is looking very good as an emerging market compared to its peers, South Africa, Brazil, Turkey, Russia. That will also reflect in sentiment on bond yields. So I think bond yields are reflecting a combination of all these factors: lower commodities, the inflation profile getting better, the fisc looking better, and more generally, India looking a more attractive market given current conditions.
But just to get that point clear, you are saying it would be wrong to expect the RBI to cut rates, as some have been saying, as early as maybe February 2015. You're saying that would be wrong?
You can never say never, because so many things can move. Who would have thought 3 months ago that the monsoon would have made such a recovery and oil would be at $80 or $85 a barrel?
But where do you stand? As things are right now, Sajid, where do you stand?
I think it will be a little bit premature. Yeah. I feel that clearly inflation risks have abated. I think the 6% is now looking visible, but there are 2 or 3 risks on the horizon, and let me spell them out. The first is, we're looking at inflation today when growth is still tracking in the mid-4s. Our sense is July to September GDP growth will be around 4.6 or 4.7. What a central bank has to do is forecast a year ahead, that a year from now, when hopefully and presumably GDP growth accelerates to the 5 handle, possibly the early 6 handle in some quarters, where will core inflation be then? And that answer, I think, no one can fully comprehend. Yes, food prices have come down. The government's done some very encouraging things, selling stocks of rice and wheat, making sure that the hoarding and price manipulation is reduced. But can we be sure that structurally high food inflation, which has averaged 9% for the last 9 years, will not resurface at any point over the next year? I think we can't be 100% sure about that. Can we be sure that oil prices will remain at these levels or come down? Again, can't be sure. So when your horizon is 15, 16 months, and you've got all these risks on the horizon, I think a responsible central bank will wait wait and be really sure that there has been a structural gap down in inflation, that this is not a cyclical phenomenon for 3 or 4 months, that really structural things have changed. MSPs are a good example. MSPs have now come down for 2 successive years, and there's a sense that will continue. But you have to get similar confidence on other macroeconomic variables. It's when you have that confidence, I think, that the central bank will do it. I think what the central bank does not want to do is prematurely cut rates only to have to raise them later next year. I think the governor has repeatedly said, let's fight this inflation battle once, and when we start easing rates, let's not reverse course at that point. So I think given all of these dynamics, I'd be surprised if there's a rate cut anytime soon.
I think 3 out of 4 people on the technical advisory committee to the Reserve Bank of India, when the minutes were released, I mean, it showed that they were actually in favor of a cut, right? I think that kind of bolstered hopes that maybe a rate cut is around the corner, but that can continue. I mean, majority can on that committee or other committees can be in favor of a cut, but the decision rests with the governor, and he can hold rates high till he thinks that it's appropriate to start lowering them. Let's just talk about the target itself, and I think towards the beginning of next year, you will have the government, which also will have a role in sort of setting the inflation number. What should be the inflation number? So in August, the RBI in a way surprised everybody by saying, well, it's 6%. Our aim is 6%. What's your sense? What will the government agree to? Will it agree to 4% plus minus 2? What are we looking at? Because if the government says it's 4 plus minus 2, I mean, technically it's 6. But the point is, the RBI may say, 8%, we're on track for 8%. 6% is, of course, some time away. So we're going to wait. So actually the wait gets even longer, maybe sometime in 2016. You think that's possible?
It's possible. I think a couple of points, Prashant. I think the first thing is I think there'll be far more convergence, and there has been far more convergence between the government and the central bank on inflation management. I think inflation is not only bad economics, it's really bad politics, and we've discussed that in the past, where it was the #1 voting issue in most opinion polls and exit polls in the last general election and in the elections that happened last year. So I think the government's equally determined to bring inflation down, and you've seen that by the steps the government's taken on fighting food inflation, on MSPs, on asking FCI to sell rice and wheat, on trying to manage the price of fruits and vegetables through working on the APMC in states. I think in terms of the target, it's anybody's guess what the government will come up to. What I can tell you is how we on the Urjit Patel committee came up with the 6% number. There's no shortage of empirical evidence in India or around the world to tell you that once you get above the 5-6% level on a sustained basis, the adverse consequences to the macroeconomy multiply very rapidly. And we've seen that in the last 3 years, that post-Lehman, I want to remind you, Prashant, because we act sometimes like we've never seen low inflation in this country. Between 2001 and 2008, CPI inflation in India averaged less than 5%. It was 4.8% for 7 years. And that coincidentally, or by no coincidence, happened to be India's Goldilocks period. We had 9% growth, a current account that was largely in balance, a fiscal deficit that was improving. So, there was cause and effect. Of course, these things are all determined simultaneously. Now, fast forward to what happened post the global financial crisis. CPI inflation has averaged 10%. The current account went completely out of control. The currency came under significant pressure. Investor sentiment has been low and growth has fallen off. So I think if you look back in the last 20 years, you will find that when inflation gets above about 5 or 6% and stays there for sustainable periods of time, the adverse consequences accelerate very sharply. So I'd be surprised if the government were to come up with a number meaningfully above 6. So I think there'll be more convergence. And I think that, the time for rate cuts will come, but I think we just need to be a little bit patient. I think there are enough good things happening everywhere else in the economy. The president just approved labor reforms, the government's pushing ahead on the infrastructure front. That sentiment will remain high even if monetary policy is not eased.
The other thing, external factors, the dollar's strength. In a way, I think dollar index is 88. The rise actually has been, in a way, effective tightening, right? you don't need rate increases. That's actually the tightening has happened because the index itself has moved. The dollar itself has appreciated. What's the risk there? Because many have said, many international economists, etc., are calling for a huge dollar rally. And they're saying that, well, ECB is actually starting, maybe is on the verge of starting to buy sovereign bonds. US is actually getting out. Japan is doubling down on its efforts. So they're not stopping anytime soon. China at some point will have to provide stimulus. So people are going to rush to US dollar, and that you'll see a big rally. And that basically usually ends badly for emerging markets. How will the RBI respond to that kind of a situation?
Well, a couple of quick points. Just look at the impact on the US economy. I think one of the feedback loops that could derail a rate hike process and GDP growth process in the US is precisely dollar strength. That if you have this divergence among central banks, you've got the ECB and the BOJ continue to ease, you've got the Fed about to tighten, that itself will lead to dynamics, as you pointed out, of dollar strength. But remember, that dollar strength then has feedback loops over time into net export contribution to GDP growth in the US. But be that as it may, let's under the assumption that rate hikes come sometime between the second quarter and the fourth quarter of 2015, and you had a strong payrolls number again on Friday. I think the RBI in India is very well positioned for a variety of reasons. I think the current account has collapsed. We're currently tracking about 1.1% of GDP. Our forecast for this year is a current account of about 27 billion for the year. Remember, 2 years ago, you and I were having a discussion where the current account used to be $20 billion a quarter. So I think the external financing needs of India have gone down dramatically because oil has come down so sharply. The Reserve Bank has built significant reserves, and it's a combination of these dynamics that has actually kept the rupee very stable at a time when other emerging markets are coming under some pressure. So I think we're very well positioned to handle any Fed rate hikes, but it's another reason, I think, why you don't want to jump into rate cuts. If you're worried about the fact that the interest rate differential between Indian assets and US assets is going to narrow when the US starts increasing rates, the last thing you want to do is accentuate that narrowing by getting on an easing cycle very soon. So I think it's another reason that warrants some caution.
You think if let's just simplify it down to the exchange rate, say the dollar rupee gets to 60, crosses 62, gets to 63 plus, the RBI will aggressively provide dollars, sell dollars?
I think there are two things going on. I think the RBI has shown a disinclination for a lot of volatility in the short run, and the rupee has been remarkably stable. But I think it's a little misleading to look only at the dollar-rupee exchange rate. You've got to look at a trade-weighted basket of currencies. If you look at India's nominal effective exchange rate, which is against a basket of currencies, we've actually appreciated over the last 3 months. And that will be a little bit worrying, because what you don't want to do is get overvalued and choke off exports, which really have been the only driver of growth in the last 3 quarters. So I think what you will see from the RBI is on a week-to-week basis to minimize the volatility and avoid some of the kind of unhinged expectations that occurred last August. But over time, I won't be surprised if you see the central bank engineering a slow, gradual depreciation. In fact, they'll want some depreciation to offset inflation differentials and ensure that from a trade-weighted perspective, the rupee does not get overvalued. This is exactly the opposite of the problem we had last August. At that point, the rupee was falling and clearly overshooting its fair value.
And go to 63, 64, the RBI would be quite okay. Sajid, you're saying if it go the dollar rupee 63, 64, the RBI will be okay.
I think over time.
Actually would like that.
Yeah. I think over time, I think the RBI has said it doesn't want to target a level. So I would suspect, our own models of fair value tell us that about a 3 to 4% depreciation of the rupee-dollar exchange rate, assuming the cross currencies are stable, is perhaps warranted, given where productivity growth is, given where inflation differentials are. I don't think the RBI would want this to happen in a matter of 3 weeks. I think what they'd want to see is a smooth depreciation over time, which is orderly.
You're saying so that's the important difference. You're saying that it will want to ignore cross-currency pressures, right? And in a way, kind of live to fight another day.
No, I'm saying it'll want to keep into Well, I think it'll want to keep in mind cross-currency pressure. So the 3 to 4% is on the naive assumption that all the other cross-currencies remain stable. But for example, if the euro were to depreciate very sharply, given that Europe is a key trading partner of India, that would just mean from a fair value perspective, the rupee has to do more work and perhaps depreciate more. But I think I want to reiterate, I don't think the depreciation will happen soon or in a disorderly fashion. I think whatever your fair value number is, I think the RBI will want to a gradual drift down that doesn't cause any uncertainty or volatility to Indian corporates, for example, or those with dollar liabilities.
Okay, all right, got that.
Just want to get a sense that if interest rates are cut,
sure,
who is going to gain? I mean, who's desperate to take loans right now?
That's precisely the point. I think that the constraints, I mean, listen, it's not fair to say that there will be no impact at all. The question is, how will this impact be distributed between consumption and investment? What you want is for interest rates to spur investment in the economy, which really has been the big lacuna over the last 3-4 years. And in my view, there are still some binding constraints that are affecting investment outside of the cost of capital. You know, land acquisition is still a problem. There's still investments that need coal linkages. There are still investments that need government clearances, even though that process has clearly sped up. So it's not fair to say that interest rates will have no impact. I'm just saying that the impact is perhaps more limited currently, given that the binding constraints on growth and on investment lie outside of the cost of capital, in my view, in many sectors. And to be fair, the government has recognized that and is pushing very hard to alleviate those. And let's just make one final point. Even if it is the case that yes, a reduction in interest rates can boost growth, I think we have to take a slightly more medium-term view of things, which is that we all agree that inflation cannot remain at these elevated levels. So this is an intertemporal trade-off where you use interest rate policy currently to bring inflation down and keep it down. And once some of these structural fixes are reached, then you can begin to turn your attention to growth.
Okay, so you were pointing out some supply-side constraints for investment. I'm going to look at some demand-side constraints. If one looks at what is happening to rural wages, I think real rural wages are now almost flat, if not going down in some places. Yeah. There is a general agricultural commodity slump. I know there is a quick recent sign that there has been some sort of an uptake, but we are getting reports of some sort of distress in cotton, for instance. I mean, we've got a reporter out there in the cotton growing districts of Gujarat, and we'll get some reports out from there in a couple of days. But, rural incomes seem to be shrinking. That is one side of the demand problem that is going to emerge. The other side that you're pointing out, labor reforms. I mean, are you confident that labor reforms that have been now done in Rajasthan are going to improve employment in industry?
Well, only over time. I think, we have to be mindful of the time horizon of these things. It's only been done in one state, but it's a very encouraging sign. I think many other states will follow. And this is going to, I think, over time, have an impact on the labor market and increase employment in the organized sector, but over time. But I think let's go back to one of the bigger demand compression reasons, as you pointed out. What are the constraints? Inflation itself was one of the biggest impingers on purchasing power. If you look at why real rural wages have come down over the last 2 years, yes, some of it is because nominal wages have begun from very high levels to moderate, but it's because rural inflation was very high, and that contributed to real wages coming down. Again, in the last couple of years, you can find out that urban purchasing power has been impeded and impinged by very high urban inflation. So I think actually there will be a boost to inflation boost to consumption in the next year for a variety of reasons, with oil prices coming down and with diesel prices now being deregulated, so that the oil price decline can actually transmit to prices at the pump. And with food prices after many years of elevated structure actually remaining tepid this particular year, lower food prices, lower diesel prices, lower gasoline prices actually increases disposable income. It increases purchasing power, and all else being equal should actually boost consumption at the margin. What we need, therefore, is for investment to pick up so that any pickup in consumption doesn't front-run investment and lead to more inflation.
So isn't that the question, Sajid, that all things remaining the same? Because when commodities tend to slump, you see farm incomes shrinking. When oil prices go down, it's an indication that there's not enough demand. Of course, for India, that's a separate issue. So do all things remain the same when prices start moderating?
No, undoubtedly. There are terms of trade changes. There are winners and losers. There's no doubt about that. But, we have to choose what we want. If we're going to complain that food inflation at 10% is unsustainably high, then when food inflation comes down, there will be some losers and some people will be hurt. And the question is, how do you mitigate those losers? But we have to agree that I think nobody believes that living with 10% food inflation, because some people benefit from that, is a good thing for the economy. I think on the agriculture sector, it doesn't necessarily have to be a zero-sum game. What you've seen in the last 2 years is that even though there are high prices in urban areas and paid by consumers, the transmission of price signals to the farm economy gets severely impeded, and farmers actually don't get, or at least small farmers don't get to see the impact of those higher prices, cannot adjust their production patterns. Why? Because the supply chain is completely broken. You've got multiple levels of intermediaries, the infrastructure is not good. So there is a point to be made that if you can get those fixes done on the supply chain, on infrastructure, you don't necessarily have to have farmers being much worse off for urban consumers to be better off.
So again, I'm just going to go back to the labor reform point. Now, if you have, I think in Rajasthan now, if you employ up to 300 people, you can retrench without government clearing it, and you can also shut shop if you want, right? Now, 85% of Rajasthan's factories actually employ less than 100 people. Right? Do you think that this is going to lead to more people being employed in the organized sector, or is this just a minor change which is not going to make a difference on the ground?
No, I think over time it will make a change. Now, of course, these things, I think the government's focus has been incremental, so they want to take 100 to 300, and hopefully that will become higher, the exemption will be increased over time. I think it will make a difference. I believe that much of India's industrial growth in the last 10 years has been in sectors that are very capital intensive. Engineering goods, pharmaceuticals. If you look at India's export basket, that's the bulk of what we're exporting today, not some of the more labor intensive sectors like textile, leather, gems and jewelry. Now, there are multiple reasons for that. I don't want to be simplistic, but one of the reasons is that to employ labor and to increase scale is not easy. The cost of that is very high given some of these draconian labor laws. So what happens is you hurt the very constituency, labor, that the law was intended to protect. So I do believe, yes, releasing some of these constraints will, over time, I think this is not a 6-month or 12-month impact, it will be several years before firms and employers realize that the relative cost of labor has come down. There's far more flexibility to respond to a business cycle, and therefore they should change the capital labor ratio in their production process.
But really, on the ground, Sajid, if one looks at reports, then much of what is employed is actually contract labor. I mean, the labor is actually farmed out. That's whatever you hear from the ground. So on the books, you show less than 100, but you're actually employing about 300 odd. All that allowing people to retrench up to a level of 300 does is essentially brings up the cost of labor. Because when you hire contract labor, you don't really pay the minimum wages.
Right, but at least you now have a manner where the labor that is being employed has got better protection, right? So, I mean, you are hiring contract labor and there were discrepancies in the organization between who's contract and who's permanent, precisely because you had to find a way to get around these laws. So hopefully over time what you'll find is, yes, you employ, because you've got, I would say the cost of contract labor is more than just is apparent. that because you have to go around the system, there are many other costs that you have to incur. So by essentially increasing these exemptions, allowing firms to go through the front door, I think over time the perception that the cost of labor has come down, that the flexibility of responding to business cycles is greater, will actually do good to labor in my view.
Well, in the factory sector in 2012-13, the cost of labor as a part of overall cost is 2.1%. So what are you going to reduce from there?
No, but that's because you've chosen to be very, I mean, this is the counterfactual, right? The point I was making earlier, that you've chosen purposely to be very capital intensive. So if those numbers are to be believed, the cost of labor is lower because you're largely using a lot of mechanization to avoid incurring labor who you think is an inflexible factor of production, which you cannot scale up or scale down. So I think that's a bit deceptive to look at it that way. The question is, over time, will there be a transition in Indian manufacturing away from capital incentive techniques and capital intensive sectors to those sectors which are more labor intensive? And I think we can't get a sense of that by looking at the current fraction of labor. It reflects the fact that entrepreneurs have chosen a very capital intensive technique precisely because they perceive the cost of labor to be very high and the rigidity is to be very great.
What I'm trying to get at is that do you think you're saying that it'll take 2-3 years for people to realize that it's better to have organized labor than contract. But in the immediate future, do you think that there has to be much more done by the government directly in the economy, in employing people, in rolling out projects, than just expect the private sector to start investing just because interest rates will go down?
Yeah. So I'll just make one quick point on the labor front. If you just look at the textile sector, for example, it's a classic case in point. Chinese wages have gone up. China has been a big textile exporter, and ordinarily India should have been the natural successor to that production process. Instead, because of all the issues we've discussed, where has that textile market gone? It's gone to Bangladesh, it's gone to Vietnam. So I think it's when the perception changes that, productivity has picked up, there are less rigidities on the ground, you can scale up more easily, that India will become a more attractive destination, for example, of textiles. I think to your issue about should the government do more, I think the approach of being gradual is good. But I think the government needs to continue moving on that front. And frankly, in the last 3 weeks after the election results came out in Maharashtra and Haryana, you have seen a pickup in the process. I think specifically on the area of investment, my own view is that getting private investment to get going again is going to take a little while for all the reasons we've discussed. Implementation bottlenecks on the ground, in some people's views, the cost of capital, the fact that leverage is very high on many infrastructure firms, the fact that you've got non-performing assets and banks that make banks more risk-averse to lending and therefore credit growth is weak. I think all of these issues will get resolved, but they'll take a little time. Therefore, it becomes even more imperative that in the next budget in February, that you have a much greater fraction of expenditure devoted to CapEx. We've experienced some challenges with the public-private partnership way of building infrastructure. And so I think in some sectors, highways, for example, you need to just do more EPC. You need to create resources on the budget where the government can actually pay for this infrastructure and the private sector can subsequently operate it. So I think, yes, in the near term to jumpstart public investment, infrastructure, we will need more resources from the government while some of these private sector issues get resolved.
All right, Sajid Chinoy, thank you so much for joining us. Always a pleasure to talk to you with your different views. Thanks a lot.